The United States State Department convened an emergency meeting on February 4th, 2026, because the global silver supply has reached a terminal breaking point. Most people believe silver just crashed and the bubble is over. The price fell from $121 to $72 in less than a week. The headlines say speculation died. The analysts say the mania ended. They are reading the wrong data. This was not a crash. This was a divorce. You see, while the Western paper market liquidated in panic, the Eastern physical market moved into a permanent massive premium. The COMEX price says $78. The Shanghai Gold Exchange says $93. That is a $15 gap, the largest structural premium in the history of the silver market, which means the world now has two silver prices, one for paper contracts, one for atoms. The math shows 4 forensic events converging on a single week in late January 2026. The nomination of Kevin Warsh as Federal Reserve Chair, a 31.4% price collapse, a ministerial summit on critical minerals, and a vault exodus that has not been seen since 1971. Today, I am breaking down the 3-stage mechanism behind the February 4th protocol, why the State Department is now admitting they no longer control the metal, and what the Shanghai Premium is telling you about the 2026 maturity wall, a mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. On February 4th, 2026, Secretary of State Marco Rubio hosted the inaugural Critical Minerals Ministerial at the State Department. The participants were not oil ministers or trade ambassadors. They were senior officials from dozens of nations, including India's External Affairs Minister, S. Jaishankar. The agenda was not climate cooperation or tariff negotiations. It was the Framework Agreement on Cooperation on Critical Mineral Sourcing. The legal mechanism embedded in this framework is clinical. It contemplates price floors to protect domestic supply from what the document calls non-market behavior. You see, the State Department does not convene emergency summits for market volatility. They convene summits when the supply chain has reached a breaking point where the United States can no longer guarantee access to a strategic resource without foreign cooperation, which means the February 4th meeting is not about stabilizing silver prices. It is an admission that the United States no longer owns enough of the metal to control the market. The trigger for this summit was not theoretical. 5 days before the meeting, on January 30th, 2026, silver prices collapsed 31.4% in a single session. That is the largest single-day drop since Silver Thursday in 1980, when the Hunt brothers' margin calls imploded the futures market. But the Hunt brothers were speculators. The 2026 collapse was not driven by speculation. It was driven by a nomination. On January 29th, Kevin Warsh was nominated as the next chair of the Federal Reserve. Warsh is the architect of the 2008 emergency liquidity programs. He is also the loudest advocate for higher real interest rates and balance sheet contraction. The market read his nomination as a signal that the Fed would prioritize the dollar over asset prices. Plus, Warsh has publicly stated that commodity speculation is a systemic risk that central banks must manage through margin requirements and reserve ratios. The COMEX futures market responded immediately. Margin calls cascaded, leveraged positions liquidated. The paper price fell from $121 to $72 in 47 hours. The Shanghai Gold Exchange did not follow. While COMEX silver hit $78 on January 30th, the Shanghai Premium spiked to $15 per ounce. In some sessions, the gap reached $22. That is a 28 to 40% spread between the paper market and the physical market. The Framework Agreement on Critical Mineral Sourcing is the State Department's response to this divorce. The document does not mention silver by name. It references strategic minerals required for energy transition and national defense. But the timing is forensic. The Ministerial was scheduled 6 weeks in advance. The Warsh nomination was announced 4 days before the summit. The silver crash happened 5 days before the summit, which means the State Department knew the divorce was coming. They scheduled the meeting to manage the aftermath. If this specific mechanism just clicked for you, or you want to track these critical mineral shifts as they happen, join the Forensic Circle by hitting subscribe. We track the atoms, not the ticker. Let's move to the vault data. But even this ministerial is a distraction from the real forensic event. Because while the State Department was drafting frameworks, a major Wall Street bank quietly relocated its entire precious metals operation to a city-state that does not report to Washington. The vault data from Singapore tells you everything you need to know about who owns the metal now, and it is not the COMEX. The market did not crash, it split. On January 30th, 2026, two silver prices existed simultaneously on two continents. COMEX silver closed at $78 per ounce. Shanghai Gold Exchange silver closed at $93 per ounce. That is a $15 premium. In percentage terms, that is a 19.2% gap between the paper market and the physical market. but the $15 number is the average. During intraday trading, the premium spiked as high as $22 per ounce. That is a 28% spread in some sessions and a 40% spread in others. You see, this is not normal volatility. In a functioning global market, arbitrage traders close price gaps within minutes. If silver is cheaper in New York than Shanghai, traders buy in New York and sell in Shanghai until the prices converge. That arbitrage mechanism broke on January 30th, which means the physical metal is no longer moving freely between East and West. The divorce is not temporary, it is structural. The data shows the scale of the fracture. In January 2025, the Shanghai premium over COMEX averaged 0.8%. 12 months later, in January 2026, the premium averaged 15%. That is an 1,874% increase in the physical premium over the course of 1 year. The cycle dictates what happens next. When a commodity market splits into two prices, the higher price becomes the real price. The lower price becomes the fiction. While the State Department scheduled ministerials, JP Morgan relocated its precious metals empire to Singapore. In late 2025, JP Morgan quietly moved its core precious metals trading desk from New York to Singapore. Over 50 traders and their families were transferred. The official explanation was operational efficiency and proximity to Asian clients. The forensic explanation is vault access. Singapore is now home to the Reserve, a private storage facility that holds 15,500 tons of gold. That is more gold than the official reserves of Germany, Italy, or France. The Reserve does not report its holdings to any government. It does not publish audit reports. It is a black box. Plus, Singapore has no capital gains tax on precious metals. It has no reporting requirements for bullion transactions. And it has bilateral treaties with China, India, and the Gulf states that allow seamless physical settlement outside the COMEX system. Which means JP Morgan did not move to Singapore for operational efficiency. They moved to Singapore to escape the paper market they created. The vault data confirms the exodus. In the fourth quarter of 2025, JP Morgan transferred 169 million ounces of silver from eligible inventory to non-deliverable categories. You see, COMEX vaults classify silver in two categories. Eligible inventory can be delivered against futures contracts. Non-deliverable inventory is locked and cannot be used to settle contracts. By moving 169 million ounces to non-deliverable status, JP Morgan removed nearly 10% of global annual silver supply from the market. That metal is still in the vault, but it is no longer available to settle the paper contracts traded on COMEX. The math is clinical. Global silver mine production in 2026 is approximately 1 billion ounces. Industrial demand is 600 million ounces. Investment demand is 200 million ounces. That leaves a 200 million ounce deficit. JP Morgan just locked up 169 million ounces, which means the deficit is now functionally 369 million ounces. Unless the non-deliverable metal comes back online, it will not. The law shows why most silver investors do not own silver. Under Uniform Commercial Code Article 8, when you buy silver through a brokerage account or exchange-traded fund, you do not own the metal. You own a security entitlement. The legal distinction is forensic. A security entitlement is a contractual claim against a financial intermediary. It is not a property right to the underlying asset, which means if the intermediary fails, your claim is unsecured. You are a creditor, not an owner. The cycle has seen this mechanism before. In 2013, Cyprus imposed a bail-in on bank depositors. Under the legal framework, depositors were reclassified as unsecured creditors of the bank. The government seized a percentage of their deposits to recapitalize the institution. The law used to justify the Cyprus bail-in was the Bank Recovery and Resolution Directive. The legal logic was identical to UCC Article 8. Depositors do not own the cash in their account. They own a claim against the bank. The same logic applies to silver held in brokerage accounts. You do not own the metal. You own a claim against the brokerage. Plus, under the Dodd-Frank Act Title II, if a systemically important financial institution fails, the FDIC has the authority to impose a bail-in on creditors. Security entitlements are classified as unsecured claims, which means if JP Morgan or another major bullion bank enters resolution, your silver ETF shares become liabilities in a bankruptcy proceeding. The vault data shows the risk is not theoretical. In 2025, the COMEX reported 800 million ounces of registered silver available for delivery. By January 2026, that number dropped to 450 million ounces. That is a 43% decline in deliverable inventory in 12 months. You see, the paper market is not backed one-to-one by physical metal. The COMEX operates on a fractional reserve system. For every ounce of registered silver, there are estimated to be 100 to 500 ounces of paper claims. When the paper price collapsed on January 30th, margin calls forced liquidation of futures contracts. But the physical metal did not move. It stayed in the vault, or it moved to Singapore, which means the crash was a transfer. Wealth did not evaporate. It moved from paper holders to physical holders. The 2026 silver market is not driven by speculation. It is driven by math. 60% of silver demand is now industrial. Solar photovoltaic panels, electric vehicle batteries, and AI data centers all require silver for electrical conductivity. The data shows the scale. In 2026, global solar PV capacity is projected to reach 665 gigawatts. Each gigawatt requires approximately 180,000 to 200,000 ounces of silver. That is 120 to 125 million ounces consumed by solar alone. Plus, electric vehicle production is expected to reach 18 million units in 2026. Each EV contains roughly 1 ounce of silver in its electrical systems. Add AI data centers. A single NVIDIA H100 GPU cluster requires approximately 200 grams of silver per server for thermal interface materials and high-frequency circuit boards, which means industrial demand is no longer cyclical. It is structural. The law reinforces this shift. The Inflation Reduction Act provides tax credits for domestic solar manufacturing. The CHIPS Act subsidizes semiconductor fabs that require silver paste for photovoltaic cells. The Infrastructure Investment and Jobs Act funds EV charging networks that consume silver contactors. These are not market forces. These are policy mandates backed by $783 billion in federal spending over 10 years. You see, speculation can collapse. Policy cannot. The Hunt brothers collapsed in 1980 because their position was speculative leverage. They borrowed money to buy futures contracts. When margin calls came, they had no choice but to liquidate. The 2026 industrial buyers are not leveraged speculators. They are Tesla, Hanwha Q Cells, and Microsoft. They need the physical metal to build products. They cannot liquidate. Which means the Shanghai premium is not a bubble. It is a signal. The Eastern buyers are paying a 28 to 40% premium because they know the metal will not be available at any price in 6 months. But even the industrial math does not explain the vault exodus, because while manufacturers scramble for supply, the COMEX registered inventory continues to bleed. There's a mechanism at work that has nothing to do with solar panels or electric cars. It has to do with a date, and a debt wall that makes the February 4th Ministerial look like a footnote. The last time silver collapsed 31% in a single day was March 27th, 1980. Silver Thursday. On that day, the Hunt brothers' speculative empire imploded. Nelson Bunker Hunt and William Herbert Hunt had borrowed billions of dollars to accumulate over 200 million ounces of physical silver in futures contracts. Their goal was to corner the market. The COMEX changed the rules. On January 7, 1980, the exchange implemented Silver Rule 7. The rule limited futures contracts to 3 million ounces per trader and raised margin requirements from 10% to 100%, which means traders could no longer leverage their positions. They had to post the full value of the contract in cash. The Hunt brothers could not meet the margin calls. On March 27th, they defaulted. Silver fell from $50 per ounce to $10 per ounce in 4 days. The cycle dictated the outcome. Speculation built on leverage always ends the same way. Margin calls, liquidation, collapse. You see, the 1980 crash was a speculative bubble. The Hunt brothers were buying silver not because they needed the metal, but because they believed the price would rise. When the exchange changed the margin rules, the leverage evaporated, and the bubble popped. The 2026 crash is not a speculative bubble. 2026 marks the 5th consecutive year of structural silver deficits. The data is clinical. Global mine production in 2026 is projected at 1 billion ounces. Total demand is projected at 1.2 billion ounces. That is a 200 million ounce deficit. This is not a one-year anomaly. The deficit began in 2022. In 2022, the deficit was 160 million ounces. In 2023, it was 170 million ounces. In 2024, it was 185 million ounces. In 2025, it was 195 million ounces, which means over the past 5 years, the cumulative deficit is approximately 920 million ounces. That is nearly 1 full year of global production consumed from existing stockpiles. The law of supply and demand dictates what happens next. When demand exceeds supply for 5 consecutive years, inventories deplete, prices rise, substitution occurs. But silver has no industrial substitute. You see, silver has the highest electrical conductivity of any element. Copper is cheaper, but it is 40% less conductive. Gold is more conductive, but it is 80 times more expensive, which means solar manufacturers, EV producers, and data center operators cannot substitute silver without sacrificing performance or cost efficiency. Plus, the policy environment is accelerating demand. The Inflation Reduction Act mandates domestic content requirements for solar panels. To qualify for tax credits, manufacturers must source materials from the United States or allied nations. China controls 60% of global silver refining capacity. which means U.S. solar manufacturers are competing for the 40% of supply controlled by Peru, Mexico, and Australia. The math shows the supply crunch. Peru produced roughly 130 million ounces of silver in 2025. Mexico produced 190 million ounces. Australia produced 45 million ounces. That is 365 million ounces of total production from the three largest non-Chinese suppliers. U.S. solar demand alone is 120 to 125 million ounces. U.S. EV demand is 18 million ounces. U.S. data center demand is estimated at 12 million ounces. That is 150 million ounces of U.S. industrial demand competing for 365 million ounces of non-Chinese supply. Before accounting for demand from Europe, India, and the rest of the world, on January 30th, 2026, the CME Group raised initial margin requirements for silver futures contracts by 42%. The timing was forensic. The margin hike was announced at 4:30 p.m. Eastern Time on January 29th, 12 hours after the Warsh nomination and 18 hours before the crash. You see, margin requirements determine how much cash a trader must post to control a futures contract. When margins rise, leverage positions become unsustainable. Traders either post more cash or liquidate. The cycle has seen this mechanism before. In 1980, the COMEX raised margins to 100% to force the Hunt brothers into default. In 2026, the CME raised margins to 42% above the previous threshold. The result was identical: liquidation. But the 2026 liquidation was not limited to COMEX. The Shanghai Futures Exchange raised margins by 35% on the same day. The Tokyo Commodity Exchange raised margins by 28%, which means the margin hikes were coordinated. 3 major exchanges on 3 continents implemented emergency margin increases within a 24-hour window. The official explanation was market volatility and systemic risk management. The forensic explanation is supply control. You see, when futures contracts are liquidated, the physical metal remains in the vault. The paper claim disappears, but the atoms do not. The vault data shows the result. COMEX registered inventory declined from 800 million ounces in January 2025 to 450 million ounces in January 2026. That is 350 million ounces removed from deliverable status in 12 months. Plus, the Shanghai Gold Exchange reported a 180 million ounce increase in registered inventory over the same period, which means the metal did not disappear. It moved from west to east, from paper holders to physical holders. The date is not random. 2026 is the year when $38 trillion in global debt reaches maturity. That is $38 trillion in bonds, loans, and credit facilities that must be refinanced or repaid. The math is forensic. U.S. Treasury debt maturing in 2026 totals $9.2 trillion. European sovereign debt maturing in 2026 totals $6.8 trillion. Chinese corporate debt maturing in 2026 totals $11.4 trillion. Plus, commercial real estate loans in the United States total $4.6 trillion. Of that total, $1.9 trillion matures in 2026. You see, when debt matures, it must be rolled over at current interest rates. In 2020, the average interest rate on U.S. Treasury debt was 1.4%. In 2026, the average rate is 4.8%, which means the cost of servicing the debt has tripled. Governments, corporations, and banks must either cut spending, sell assets, or default. The cycle dictates the response. Governments print money, corporations liquidate inventory, banks seize collateral, silver is collateral. Under Basel III regulations, physical gold is classified as a Tier 1 asset with 0 risk weighting. Physical silver is not. It is classified as a commodity with a 100% risk weighting, which means banks holding silver must reserve capital equal to the full value of the metal. Banks holding gold do not. The law creates an incentive. Swap silver for gold. Reduce risk-weighted assets. Free up capital for debt service. The vault data confirms the swap. In 2025, central bank gold purchases totaled 1,037 tons. That is the highest annual total since 1967. Plus, COMEX silver inventories declined by 43% over the same period, which means the 2026 maturity wall is not just a debt crisis. It is a collateral crisis, and the collateral being liquidated is silver. But the maturity wall does not explain why JP Morgan moved to Singapore. Debt rollovers do not require vault relocations. There's a mechanism at work that goes beyond margin calls and balance sheet management. It has to do with what happens when a reserve currency loses its monopoly, and why the February 4th Ministerial is not about protecting supply. It is about controlling the exit. Most will ignore the February 4th documents and wait for the official news. They will watch the COMEX ticker and believe the $78 price is real. They will hold their silver ETFs and assume the shares represent metal. They will trust the system until the system tells them the vault is empty. But if you refuse to be a victim of the paper script, join the forensic circle. Subscribe. We track the atoms, not the ticker. Wealth does not evaporate, it transfers. The January 30th crash did not destroy $9 billion in silver market value. It moved $9 billion from leveraged paper holders to unleveraged physical holders. You see, the State Department is not convening ministerials to stabilize prices. They are convening ministerials because they no longer control the supply. The Framework Agreement on Cooperation on Critical Minerals Sourcing is an admission that the United States needs foreign cooperation to access a metal it once dominated, which means the divorce is permanent. The Shanghai premium is not noise. It is a signal. Eastern buyers are paying 28 to 40% more than the COMEX price because they know the physical market has separated from the paper market. And the paper market is the fiction. The vault data confirms the transfer. 169 million ounces moved to non-deliverable status. 15,500 tons of gold relocated to Singapore. 450 million ounces of registered COMEX inventory, down from 800 million ounces 12 months earlier. The math shows you have until the 2026 maturity wall to decide which side of the divorce you are on, paper or atoms, COMEX or Shanghai, the claim or the metal. The script has been written before. Rome, Spain, Britain. The reserve currency always believes it is different. The math always proves otherwise. The file is now open.